There's a door on the 14th floor with nothing on it but a number. No logo, no company name, no frosted glass with a stock photo of a lighthouse behind it. Just 14,008 in brushed steel and a badge reader that turns green for you at 11:40 at night, because somebody in facilities decided years ago that the guy who empties the bins needs access to everything. Your name is Dez Halloran. You do the 14th floor between 11 and midnight. 11 bins. One conference table long enough to seat 16 people you have never once seen sitting at it. A kitchen with a coffee machine that costs more than your car is currently worth, and a fridge with 3 sparkling waters in it that nobody has touched since March. Then you drive home to a checking account with $612 in it. The people behind that door manage $1.4 billion. Not for a bank, not for a fund, not for clients, plural. For one family, 4 adults, 9 grandchildren, and a paper mill in Wisconsin that stopped making paper in 1998 and somehow still pays for everything. They call it a family office. You had to look it up the first week on your phone in the parking garage, because the phrase sounded like an insurance branch in a strip mall. It isn't. A family office is what money builds around itself when it gets big enough that no existing product will hold it. When John D. Rockefeller decided in 1882 that no bank was going to run his fortune for him and hired his own staff to do it instead, that was the first one. Everything behind door 1408 is 140 years of that same idea, wearing a badge reader. And here's the part nobody tells you when you're standing in a hallway at midnight with a cart. There isn't one version of this. There are levels. 6 of them, roughly, between an account like yours and an office like theirs, and at every single level a different machine assembles itself around the money. Different people, different fees, different problems entirely. The machine at $1 million looks nothing like the machine at $100 million. And the machine at $5 billion isn't even trying to solve the same question anymore. So start where you actually are, level 0, $612 and a badge that opens a door you'll only ever be on the cleaning side of. Level 1, 0 to $1 million, and you are the family office. This is the level almost nobody describes honestly because there's nothing to sell you here. At $612, and at $6,000, and at $60,000, and honestly most of the way to $1 million, the answer to who manages your money is a mirror. You are the chief investment officer. You are the accountant. You are the estate planner and the risk committee and the compliance department, and you are also the guy doing the 14th floor at 11:40 at night, because the family office at this level does not pay a salary. You learn where the gates are pretty fast once you start looking for them. Around $200,000 in investable assets, a big bank will move you into a premium tier with a name that sounds like a medal. You get a phone number that a person actually answers. Around $1 million, you get bumped again, private client they call it, and now there's a name attached to your account, someone who takes you to lunch once a year and remembers your kids' names off a screen. Around 10 million, the actual private bank opens up. That's the first tier where the institution starts doing work instead of just holding the money. That's the whole bank ladder, and you notice something about it standing in the garage reading it on your phone. Every rung is defined by how much attention your money is allowed to buy. Not returns, attention. At level 1, you can't buy any. So you have exactly 2 jobs. The first is automating the inflow, because willpower is not a financial strategy and you already know this about yourself. The money that moves on payday before you see it is the only money that reliably moves at all. If there's a match on a retirement plan at work, that's the closest thing to free money that exists anywhere on this ladder, an instant 50 or 100% return that no chief investment officer at any level can replicate, and a startling number of the people offered one leave part of it sitting on the table every year. The second job is not losing the principal, which sounds obvious right up until you're 8 months in with $4,000 saved and a guy at work is telling you about something that returns 40% a month. At level 1, a wipeout doesn't cost you money, it costs you the years it took to accumulate it, which is the only asset you actually have. That's why the first real milestone isn't $1 million. It's the boring one, 3 to 6 months of expenses sitting somewhere unexciting, so that a transmission doesn't undo 2 years of shifts. You do the math on a napkin in the break room, the way you've started doing since you began paying attention. $612 in checking. Rent in 11 days. If you move $75 a week, 1 shift's worth of overtime, roughly, 1 grocery run's worth of discipline, that's $3,900 in a year. Not life-changing, not a headline, but run it out. $75 a week, held for 20 years, growing at 7%, is somewhere north of $160,000. And that number is doing something strange to you, standing in a break room at midnight, because it isn't a fantasy. It's just arithmetic that requires you to still be here in 20 years. Nobody behind door 1408 has ever had to think about that. Their whole architecture exists because the money already arrived. Yours exists because it hasn't. which is why nothing really changes at level 1 until the day the money arrives all at once. And when it does, at the exact moment a life's worth of work turns into a single wire transfer, the machine finally shows up. Level 2, $10 million, and the first person you pay to care. You know exactly what this level looks like because Kip Ferrante lives at 2 doors down from your sister, and Kip cannot stop talking about it. Kip owns 7 sandwich franchises across 3 counties and sold the whole thing at 54 for $12 million, and the first thing that happened to him, before the boat, before the truck, before the second house in Scottsdale nobody in his family wanted to visit, was that a wealth management firm found him within 9 days of the sale closing. He tells this story like it's a compliment. You've started hearing it as a warning. Because here's what actually changes at 10 million. For the first time, someone else is paid to hold your money's attention. An advisor, a registered investment advisor, a team with a conference room and a slide deck. And the price of that attention is usually about 1% of everything you have every year for as long as you have it. On $12 million, that's roughly $120,000 a year. Kip has never written a check for it. It comes out of the accounts quietly, quarterly, forever, and he could not tell you the number if you asked him cold. That's not a scandal. That fee buys real things, and the real things are not stock picks. They're the boring machinery that money over 8 figures cannot function without. Because this is the level where your money grows a legal shape. You get a will that actually works. You get trusts, irrevocable ones. The kind where you give something away on purpose so it stops being yours for tax purposes and starts being your kid's on a schedule you wrote while you were still alive. You get an estate plan that assumes you will die at an inconvenient moment because everybody does. You get a CPA who talks to the lawyer and a lawyer who talks to the advisor, and if you're lucky one of them notices when the other two contradict each other. And there's a hard number underneath all of it that explains why anybody bothers. There's a limit to what you can hand down before the federal estate tax takes its cut, and above that line the rate runs to 40%. 40%, not of the gain of the thing. Every hour Kip spent behind a sandwich counter for 30 years, and a fee schedule written in Washington decides whether 4 of every $10 past the line survives him. Move assets out of your estate early enough, and the growth after that point happens outside it. Move them late, and you're just donating to the Treasury with extra steps. That exemption line moves every time Congress touches it, which is exactly why the planning happens years ahead of the funeral instead of the week after. Kip's advisor moved $8 million into a trust structure the first year. Kip described it to you across a fence as some paperwork thing. What it actually was the first time in his life a decision he made would still be operating 50 years after he stopped being able to change it. And here's the thing that finally clicks for you, thinking about Kip's $12 million while you're wiping down a table for 16. The reason he'll eventually outgrow that advisor has nothing to do with performance. It's that at 10 million, Kip owns 4 things. At 30 million, he'll own 19, an operating company, 3 LLCs, some raw land, a stake in his nephew's HVAC business, a life insurance policy nobody understands, and an account at each of 4 different institutions that have never once spoken to each other. Nobody will be able to answer the single simplest question in all of finance. What do I actually have today in one number? That question is what pushes people to the next level. Not greed, not returns, filing cabinets. Level 3. 25 to 50 million, and you rent the machine instead of building it. You learn this one from Dez Halloran, which is not how you expected to learn anything. She's behind door 1408 at 12:20 on a Tuesday morning, alone, when you badge in with the cart because the light was off and you assume the floor was empty. She doesn't jump, she just looks up from 2 monitors and says, "You're the one who stacks the sparkling waters label out." Ada runs the office, chief investment officer for the paper mill family, 9 years now. She's 51, wearing a fleece with a company logo on it from a company that isn't hers, and she asks if you want coffee from the machine you clean 4 nights a week and have never once used. You say yes, that's how it starts. Over about 6 weeks of accidental 20-minute conversations, she walks you up the ladder, and level 3 is the one she says people misunderstand the most. Between roughly $25 and $50 million, families stop hiring an advisor and start joining a multifamily office. And the distinction sounds like semantics until she explains what you're actually buying. A multi-family office is one set of infrastructure, investment staff, tax people, reporting systems, sometimes a general counsel serving a handful of families at once. Some open their doors at 10 million. Most want 25 to 50. A typical one might serve somewhere between 10 and 50 families total, which means you are not a customer number in a call queue. Somebody there knows the name of your difficult brother-in-law and why the Idaho property is titled the way it is. And what you're buying, Ada says, is almost never returns. It's the one number. Every account, every entity, every property, every private stake you own, pulled into a single consolidated report that tells you what you have and what it did this quarter. You'd think that already exists. It doesn't. At 30 million spread across 4 institutions, that number lives nowhere, and assembling it takes a person 3 weeks and a spreadsheet that breaks. People think they're buying a hedge fund, she says. They're buying a filing system with opinions. And then there's the half of the job nobody describes as finance at all. Bill payment across 6 properties, payroll for household staff, with the tax filings that come attached. Insurance on things that are annoying to insure, art, a boat, a collection of something. Coordinating the accountant and the attorney so the family isn't the messenger between 2 professionals who bill by the hour to repeat each other. Ada says a good multifamily office earns its fee somewhere in that pile, not in the markets. The trade-off is the one you'd guess. You're renting a slice of somebody else's staff, which means somebody else's staff has other families, other deadlines, other emergencies happening the same Thursday yours does. The infrastructure is excellent and it is not yours. When your priorities and the firm's priorities disagree, you find out fast that you are a client, not the client. For most families, that's completely fine. Ada's blunt about it. She thinks the majority of people who build their own office at this level are buying a status object, not a solution. And they find out around year 3 when the operating bill arrives and the CIO they hired leaves for a bigger seat. But somewhere north of this level, the math flips. There's a point where renting stops being cheaper than owning. She writes the number on the back of a receipt and slides it across the counter. Level 4, 100 million, and you build the thing yourself. The number on the receipt is $250 million, which is not the number you expected, because everything you'd read online said 100 million was the threshold. 100 million is where it becomes possible, Ada says. 250 is where it becomes sensible. There's a difference, and the difference is about 6 unhappy years. Here's the arithmetic she walks you through, and it's the cleanest thing anyone has ever explained to you about wealth. Standing up a single-family office, one family, nobody else, costs somewhere between $500,000 and $1.5 million before it has done anything at all. Entity formation, legal work, systems, the first hires, the office itself. Then it costs money every year to simply exist. $1 to $2 million annually is the ordinary range for a small one. And the rule of thumb everyone in the industry uses is that your office should cost you under 1% of what it manages. Run that against $100 million. $1.5 million a year of overhead on $100 million is 1.5%, gone before a single investment decision is made. Run it against $250 million and the same office costs you 0.6%. Same staff, same conference table. The only thing that changes what's underneath it. That's the whole secret of level 4, she says. It's not a wealth threshold, it's a break-even. There's a cheaper version most families try first, and she doesn't sneer at it. You keep the office tiny, one trusted person, sometimes just a single executive who used to be the family's accountant, and you rent everything else. The investing, the tax work, the legal, all of it goes to outside firms. What you're actually buying is one human being whose loyalty runs to the family and whose job is to hold all the outside vendors accountable. It costs a fraction of the full build, and for a lot of families at 100 million, it's the correct answer for another decade. There's a legal piece too, and it's the reason any of this is allowed to be as private as it is. Anyone managing other people's money generally has to register with the SEC as an investment advisor, reports, examinations, the whole apparatus. In 2011, under Dodd-Frank, the SEC wrote a rule that defined exactly what a family office is. Serve only your own family, be owned and controlled by that family, hold yourself out to nobody. Fit inside that definition and you're excluded from the Advisors Act entirely. Which is why DOR 1408 has no name on it. It isn't discretion as an aesthetic. Advertising is the one thing the exemption doesn't let them do. And this, Ada says, is where the psychology of the whole ladder finally turns over. At every level below this one, you are buying advice. Here you start buying loyalty. The first real hire is almost always a chief investment officer, someone whose entire professional life is pointed at one family's balance sheet and nobody else's. You are no longer choosing between products. You're choosing a person who will know more about your family's actual finances than your children will, and who could earn more somewhere else, and who has to be paid enough and trusted enough that they don't want to. That's the job, she says. The investing is the easy half. You think about that driving home. You've been in that suite 300 nights and you'd assume the machine behind the door was about markets? It's about one family deciding, permanently, whose attention their money gets to own. And then Ada tells you what happens when the money gets so big that no single person's attention is enough. Level 5. $1 billion and the money stops being an account and becomes an institution. This is Ada's level, and you can tell because it's the only one she describes in terms of people instead of numbers. The costs first because they're the part that stops you. Across the industry, a family office runs somewhere around $3 million a year on average. Cross $1 billion under management, and that figure roughly doubles, call it $6.5 million annually, and that number has been climbing year over year. $6.5 million a year to run the thing that runs the money. What that buys is a company. Not a metaphor, an actual company that happens to have exactly one customer, 20 plus people, a general counsel, a controller, and a team under them. Someone whose whole job is tax across 9 jurisdictions. A head of security who thinks about the grandchildren's travel itineraries. An HR function because you now employ people, and employees have benefits and disputes and parental leave. Some have their own IT departments, their own art registrars, their own pilots. Ada's has a woman whose entire role is the paper mill site in Wisconsin that hasn't produced anything since 1998 because the land, the environmental liability, and the sentiment attached to it are 3 different problems, and all 3 are permanent. And the investing changes shape completely at this level. Below $1 billion, you mostly buy access funds, managers, other people's decisions priced accordingly. At $1 billion and above, you start doing deals directly. Buying companies whole. Co-investing alongside private equity firms without paying their fee layer. Because you can write the check yourself and you don't have investors to answer to or a fund life forcing you to sell in 7 years. That last part is the actual superpower, and it's the one nobody puts in a thumbnail. Every professional investor on earth is running against somebody else's clock. A quarter, a fund term, a redemption window. A fund manager who believes in something for 20 years still has to explain a bad 18 months to people who can pull their money out. A family office at this size has no clock and no redemptions. It can hold a thing for 30 years because the family feels like it. Patience stops being a virtue and becomes an asset class. The flip side is a risk that doesn't exist anywhere below this level. A company with one customer, no external oversight, and total discretion over billions of dollars is exactly the shape of thing that goes wrong quietly. Nobody's auditing the way a fund's investors would. Nobody files a complaint. Every few years a story surfaces about an office where one person had signing authority over everything for a decade, and by the time anyone checked, there was significantly less than there was supposed to be. Ada's controller and her CIO are deliberately not the same person, and neither of them can move money alone. That's not paranoia. It's the entire reason the job pays what it pays. But something's been bothering you for weeks, and one night you finally say it out loud while she's refilling the coffee. If she manages $1 billion and she could clearly go run money anywhere, why is she in a fleece at 12:20 in the morning? Ada laughs at that. Because at this level, I'm not really an investor anymore, she says. I'm an employer. I run a business whose only product is a family's ability to stay a family. You didn't understand what she meant that night. You understand it about 4 months later when the cousins arrive. Level 6, $5 billion, and the problem stops being money entirely. You should know what the top of this ladder actually looks like, because the real numbers are stranger than anything you'd guess from a hallway. The largest family office in the world is Walton Enterprises, Sam Walton's descendants, sitting on something in the neighborhood of $224 billion. Behind it, Cascade Investment, which runs Bill Gates' personal money. Behind that, Bezos Expeditions. Add up the 10 biggest and you clear $1 trillion managed by entities most people have never heard the names of, which is precisely the point. At $5 billion, Ada tells you, nobody in the building is worried about returns anymore. $5 billion invested even conservatively throws off more each year than the family can plausibly spend. The math is solved. What isn't solved is people. And the reason she can describe that level so precisely from $1 billion is that this problem doesn't wait for the money to arrive. It shows up one generation early, every time, in every family, at every size. $5 billion is just where it becomes the only problem left. You watch it happen in real time on a Thursday in April. 9 grandchildren, the 3rd generation, and 7 of them are in the conference room you've wiped down 400 times. 2 aren't, and everyone in the room knows exactly why. There's catering. There's a lawyer you've never seen. It runs until almost 1 in the morning, which is how you end up standing in the hallway with your cart, not going in. What they're arguing about is a document Ada calls the family constitution, and it is the single least glamorous and most important object in the entire building. Who sits on the board? How a decision gets made when the family splits 4 to 5? What happens when a grandchild wants out? Whether they can force a sale, at what valuation, on what timeline, and who has to approve it? Whether marrying into the family means anything financially. Whether working for the office is a right or a job you have to be qualified for. Every one of those is a question about affection disguised as a question about governance. Wealth doesn't usually die from bad investing, Ada says the next week, and this is the line that stays with you for months. It dies from a funeral where nobody agreed in advance what happens next. That's the thing they never tell you at the bottom of the ladder. Every level up to 4 was a problem you could solve by buying the right service. Level 5 you solve by hiring the right people. And level 6, the top $5 billion, the trillion-dollar names, the paper mill family arriving early, you cannot buy the solution at all, because the solution is 9 adults who still take each other's calls, and there is no product for that at any price. 2 of the grandchildren still don't come to the building. Ada manages $1.4 billion flawlessly and cannot fix it. You're still doing the 14th floor at 11:40. That part didn't change, but the ladder looks different to you now, because you've noticed it's the same shape at every rung. At 1 million, at 50 million, at 5 billion, the question never actually changes. Who holds this money's attention? Who is paid to notice it, and how much of it goes to them, and what happens to it the day you stop being able to decide? At level 1, that person is you, unpaid, at midnight on a napkin. At level 4, it costs $1.5 million a year and comes with a chief investment officer. The difference between those two is enormous in dollars and almost nothing in kind. Every family office on earth is just somebody deciding, deliberately, that their money deserves a job description. Which means the only real gap between $612 and door 1408 isn't the 6 zeros. It's whether anyone is paying attention at all, and the levels themselves stop looking like achievements once you see what triggers each one. Nobody graduates to a multifamily office because they got richer. They graduate because they got more complicated, and complexity is the actual currency of this whole ladder. Kip's 12 million didn't need an institution. Kip's 19 entities did. The paper mill family doesn't employ 20 people because they have $1.4 billion. They employ 20 people because $1.4 billion, spread across 4 generations and a dead factory, generates a full-time job's worth of questions every single day. You moved $75 last week. Not from a windfall, from a shift in a grocery run and skipping the thing you were going to skip anyway. Your account says $687 now, and it'll say something smaller by the 15th and something bigger by the end of the month if you keep doing it. Nobody catered that. There's no lawyer, no constitution, no woman in a fleece at 12:20 in the morning. Nobody is going to argue about it in a conference room 40 years from now. But it's the only balance sheet in that entire building that belongs to you. And you're the CIO. $75 is still $75.